Give me a second. I gotta set it up. I gotta set it up. All right. All right. All right. Hold on. Okay. 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 So, as you are here, let me give you an applause for staying with me. All right. There's a lot happening in the financial world. A lot of us are going through a lot financially, some even mentally. So I thought maybe I might bring this to you guys. Again, I do reviews here, and also, I'm gonna change the channel back to its original content. mm, 1 second. Yeah, so we're gonna go back to its original content. I will be changing the logo because I just realized I can record here, save it, and then send it over to my other channel so you guys can enjoy. So either way, we able to grow, right? So eventually, when I'm talking about stuff for my other channel, I will have a shirt because my original channel was just me. I want to be more professional. You know what I'm saying? A little bit more professional. Excuse me. With this one, I want it to be a little bit more relaxed because I make shirts. I'm relaxed, you know. So, with that said, let's get started. Let's get started. Let's go to the other. Bam. All right. So, now let's talk about finance. Money. Life is about money. Let's go.
Social Security, Medicare. This is the modern ritual of giving away a chunk of your money to invisible forces, and they expect you to say,
hold on, give me a second. Let's go back.
federal income tax, state tax, Social Security, Medicare. This is the modern ritual of giving away a chunk of your money to invisible forces, and they expect you to say thank you. Here's the deal. Taxes are the cost of civilization. You pay, the government builds roads, funds schools, makes sure your favorite taco truck isn't infested with rats, and sends billion-dollar missiles to places you've never been. But there are different types of taxes. Income tax, which hits the money you make. Sales tax, which hits the money you spend. Capital gains tax, which hits the money your investments made while you were asleep. The government takes a little bit of every dollar. Nearly everyone also pays Social Security tax and Medicare tax. Basically, Social Security tax is like the government forcing you to save for your retirement. They force you to save money now, and you get it paid back to you over time when you retire. Medicare, however, is a health insurance tax that goes to supporting older people or people with serious health issues.
Now, hold on. I think this is too loud. Hold on 1 second. Hold on. Let me put it down a little bit. I'm just realizing. Give me a quick second. Give me a quick second. Quick second. I gotta say something about this because at the end of the day, okay. So, although all these things they're making it seem like gloom and doom, Medicare, Medicaid actually helps the elderly, which is good because if somebody's retired, they get a leg up. They're able to have something, especially if it's somebody that hasn't been working for a long time, and you have to be working for a certain amount of time to be able to get it. But you have to be age appropriate. You have to have work status in order. And you actually have to start from the beginning on building your Social Security. So in Social Security, there's a thing where you have to. So basically, go online, go to your Social Security account, right? If you're in the U.S. Once you get there, there's a section that lets you know how my tongue. It's messing up the word. How approved you are based on how long you've been giving to the system as far as Social Security, right? So after you've been giving to Social Security and all that stuff, there's points. I think it's like 40 points. It's counted by tens, And if all those bars are filled, by the time you retire, you are all set. You get your, Medicare, Medicaid, and all that stuff, and Social Security, and all the things that you need, right? Now there is an age limit. I think 65 for some, and 67, I think, for my age range, to be able to qualify for some of those things. Now these are all good things. The problem is a lot of people have these things, and they're just living their lives. It's good to start businesses. It's good to invest. It's good to do things with it so you can actually have growth. So now this video talks about a lot of loom and doom, like how people just work and it's a rat race, and at the end of the day, like, you don't save money. It all depends on you. It all depends on you. If you're smart while you're working, right, have a YouTube channel. Talk about what's going on in the world, right? If you're smart while you're working, right, start yourself a little side gig where, if you like hats, you make logos on hats, or you just buy hats and you sell them, right? Eventually what happens is, by the time you retire, you'll have a hobby. And a lot of times people that retire early, or people who retire, when they're sitting there and they're doing nothing, the body starts to I think the word is degenerate, right? It starts to, you start to feel aches, pains, because your joints are used to movements. And when you're not doing a lot of movements, it's gonna be hard. It's gonna be hard, right? Let's go back.
Comes filing your taxes? Oh boy, the government knows how much you owe, but it makes you guess. How cool. If you're right, no worries. But if you're wrong, you're cooked. When it comes to actually paying taxes, some people pay every few months. Some people pay yearly. And then there's those people that don't pay at all and end up in documentaries. I get that taxes are annoying, but it's not all bad. Countries with higher tax rates generally have a higher quality of life all round. Banks. So, you walk into a bank, hand the cashier your money, they count it, smile, and tell you it will be added to your account. You walk out and think, great, now it's sitting in a vault somewhere, being guarded by a dragon. But in reality, that money's already gone. Most people think of banks like a big safe with only one job: guarding people's money. But in reality, they are just a middleman, or a matchmaker for financial transaction. When you deposited that $1,000, the bank took $900 of it and gave it to someone who wants to buy a jet ski. That system is called fractional reserve bank.
Okay, again. This makes this seem bad. Fractional reserve banking, right? It's a system. So apparently this video, I gotta choose wiser, right? It's showing you that, oh my God, this is horrible. The system is horrible. The system is not that bad. Fractional reserve banking actually helps the community, right? So if you want a credit card, most credit card companies go to banks, they get money, then they lend it to other people, and those people pay with interest. Meanwhile, the bank is collecting interest on them. They just double it and have you pay for the interest that they would be paying, but they give you money. Now, it's up to you what you want to do with that money, right? You could use it for good, or you could just waste it and then end up in, having a bad credit report, right? So all these are good things to help you out. It's not that bad. Don't let it be all doom and gloom, because at the end of the day, these are things that's going to help you. These are things that's going to help you. But guess what? You can do the reverse. So when a bank takes your money, right? They take your money. As they take that money and they go to give it to somebody else to borrow, you can do something that's smart. When you're putting the money in the bank of your choice, as you start to put more and more money, that bank starts to like you because you're adding to their pocket. Because I think for every dollar you put, it's at least $9 or $10 for them. Why? Because they take that fractional difference and they lend it to people. People pay back with interest, or companies pay back with interest. They make their money, and then they give you a small percentage, right? Now, if you're smart, what you do is this. You come in with a big amount of money. You drop it in the bank, right? Then you go to the bank and you ask the bank for a loan. The bank's going to ask, hey, what do you have? I just dropped 10K or whatever amount you have in there. I can back it up. So now what they do is they say, okay, well, you have assets. You got money in the bank. You might have a house, a car, whatever. that creates assets for you. Now the bank says, okay, cool. They give you, or even if you have investments, crypto, regular money, whatever, stocks. Now the bank will give you out a loan, and you can use that loan to start a business. You can use that loan to buy a house. You can use that loan to do things that's legal, right? Some people take it and invest with it. Don't do that, guys. Don't lose your money, right? If you're gonna do something with it, do something that would be like, that would help you grow. That would help you grow. So fractional reserve banking is not that bad if you understand it and if you're able to utilize it correctly. All right.
Which basically relies on the idea that they only actually need to keep a fraction of the money on hand, because not everyone is going to show up at the same time asking to withdraw 100% of their account. That is, unless it's 2008, of course, when people lined up to withdraw the entirety of their account, which caused the entire system to crumble. Banks make money by lending your money at a higher interest rate than they are giving you. That's really it.
So on the other side, you don't see it's the same exact guy. He put the money in, and then he's getting the money as interest, right? A small percentage. Why is he getting that small percentage? Because like I said earlier, the bank loaned his money to somebody else, and when those people paid, or those companies paid, the difference the bank got, the bank kept the big difference, and then the rest was given to the people as a small percentage of interest to increase their money, right?
You're the supply of money, and the person borrowing is the demand. The banks entice you to deposit your money because of a few reasons.
Let's go back and look at that again, because this illustration said exactly what I was talking about. Right? Okay. So give me a second. I'm trying to get my thoughts. So where's my mouse? All right. Bam. There we go. Where the mouse is, right here. This is, let's say this is you. You give the money to the teller. The teller takes the money, and then guess what? You can come back and ask for a loan, a credit card, right? They're gonna take your money and give it back to you, and as they're giving it back to you, you pay it back with interest. That interest is what the bank basically charge you for taking out the money. Then the bank take that money that the interest that you've paid off, and then they come back and give you a small percentage of that. And then you can do it over and over and over again, right? So that's you taking out a loan from the bank. That's exactly how it looks like if you're doing this smart.
The banks entice you to deposit your money because of a few reasons. It's much easier and more convenient to spend on a card or transfer than...
Okay. This guy, this illustration, he should have had a smile on his face. Now, why? With a credit card, if he does it correctly, he can utilize the credit card to do market, right? And pay that right back before they charge him interest. So at the end of the day, he's not losing. He's growing his credit, and as he's growing his credit, the people his credit line can increase. So that's the smart thing to do, right? And also, a lot of people don't realize, and I'm about to do that same process right now. You can actually, when you open a credit card, you can actually have it direct deposit money into the credit card, right? Not all your check, like a portion of it. Let's say you buy groceries daily, like $300. You can take $300 from your paycheck that you already pay, open a credit card, have that credit card be paid $300 weekly. So as soon as you use the credit card for that week, that money's already coming in, and it's a continuous cycle. And if you do it correctly, and you never in the hole, meaning that you never owe the money because the money's immediately replaced, they just gonna keep increasing your line, where you win, right? So what this character is doing, using the credit card to do market, This is smart. This is smart, but you have to do it correctly, or else if you do it incorrectly, you're just gonna owe money, and then your credit's gonna be bad.
Carrying around cash all the time. They are literally paying you to hold your money with them in the form of interest. It is much safer to keep your money in a bank than in a shoebox in your room. In the US, most
Exactly. That's something I like. They said it's better keep it in the bank than in a shoebox, especially since pretty soon, like I said earlier, we are about to go to a digital era, and when we go to that digital era, that money you got in that shoebox, it needs to go to the bank and be accounted for, because if not, whatever you got in there is what you got in there.
banks are insured up to $250,000 per person, meaning no matter what, the government assures you that your money, up to $250K, is safe. Interest. Imagine you borrow $1,000. You have to pay back $1,280. Why? Because of interest. Interest is money's way of charging rent to exist in someone else's hands. When you borrow, interest is the price tag for using someone else's cash. When you lend or save, interest is the reward for being patient and boring. There are two main types. Simple interest is like, here's a flat fee, thanks for playing. Compound interest is, every dollar I gave you now has clones, and they also want rent. Let's say you owe 20% interest on a credit card. You miss a payment. Now your interest is earning interest. Soon, your $12 burrito turns into a $50 regret. On the flip side, investing at 7% annual compound interest, that's your money duplicating itself like a cheat code. $100 becomes $200, then $400. Then one day you wake up and you're old, rich, and
Nice. I like this one. I like this one. That's what I'm talking about. That's what I'm talking about. Ah, guys, interest, compound interest, it's all how you look at it. Because if you look at it as, oh my God, they taking my money, then learn the game and play the game, right? Come on.
a little smug about it. This is why interest is the silent engine behind both wealth and debt. In loans, it's the slow burn that turns small mistakes into financial fires. In investments, it's the time bomb that turns small gains into massive wins. So what's the hack? If you're paying interest, kill it fast. If you're earning interest, let it sit, feed it, and give it time. Interest is either your...
So if you, I remember I used to do this a long time ago. This is one of the reasons why I learned to love banks, because I couldn't believe it. So back in 2000, early 2000, they gave like 2% on your, what's that thing called? Was it 2 or 7%? I don't know. It was a big percentage compared to now. So I had money and I was working. I was young, right? I'm like 16, 17. So now as I'm accumulating money, and I didn't have rent and stuff I had to pay. I only paid for, no, I was like 18. Was it? Yeah, I was 18. Yeah, at the time, I didn't really have rent and stuff like that to pay. It was more like, I think I was in a room or whatever, room boarding, whatever. And as I'm sitting there working, OT, making money, right? I started putting it in the bank. As I'm putting it in the bank, the bankers was like, hey, come here, kid. So I came over and the banker said, hey, why don't you put your money in a CD? I'm like, why? He said, because you have a couple thousands here. Put in a CD, it'll grow interest, and that interest will pay you, and you can continue on. So I'm like, what do you mean? So they sat me down. They said, okay, cool. Let's take the money and let's put it in this. So I said, okay, cool. They said, come back in about a month. I came back in about a month. The money I had sitting there, it earned me $50. I said, what? So every month this thing can earn me $50? They said, yeah, just leave it and it's just going to keep growing. If you take, so with a CD, you can take out the interest, right? And leave the residual. The residual is the money you put in. The interest is the money you earned from the money sitting there. So your couple thousand, whatever you have sitting there, is being lended to somebody, and they give you a higher rate of interest, as opposed to you just leaving it on like a credit checking account or like a savings account. The interest is going to be a lot smaller on those because it's not doing anything, right? The CDE is basically you putting it's a lot more. The startup rate is a lot higher, so they are more they're happier to take your money and give you a bigger, amount of interest, right? So you make money, they make money, they making more money, but it is what it is. So this is one of the reasons why I learned to love interest, because if you know how to use it correctly, it can help you. If you don't, it can destroy you.
Worst enemy or your best unpaid employee. The choice is in who's collecting it. Inflation. Okay, so you bought a bag of chips. Open it up, and it looks like it's already been half eaten. You check what you paid, 30% higher than last time. Then you realize you've just been hit by inflation. Inflation is what happens when money slowly gets less valuable over time. Not overnight, not with fireworks, just a slow erosion.
Okay, another one that can be your enemy or your friend. So inflation. Start a hobby, right? A hobby could just be like you growing potatoes or you growing tomatoes, right? You then take those tomatoes, you go to a friend and you say, hey, would you like a tomato? They say, yeah. You give them the tomato or potato, whatever you grew, and they tend to want to compensate you. So as they're compensating you, what they do is they give you money to say thank you, right? Then you take that hobby and you make more potatoes. As you start to make more potatoes or tomatoes and you're selling it, now you have yourself a gig, right? A hobby, something that makes you a little bit more money. Now, let's say you decide to sell the potato for, I don't know, $1. Then you go to the market, you know what I mean? Because you about to make something and you're like, you know what? I have those potatoes to be sold. I'm not going to use it. And you take I don't know, let's say you made $10. You take your $10 to the market. You're like, let me get some tomatoes. Or let me see how much they sell their tomatoes for. You go to a market, you're selling yours for $1. They're selling theirs for like last month or 2 months ago for like $2, and now it's like $3. Now, based on the inflation, you can increase your price. So inflation can be your friend or it could be your enemy. If you're the one on the other hand buying, inflation is your enemy. But if you're the one selling, inflation can be your friend. At the end of the day, you're pretty much increasing the amount you paid, because your effort and maybe the materials might cost more. But if you calculate correctly, you can make a lot more money. Right? So yeah, so that's pretty much it when it comes to inflation. But yeah, let's go. Let's see more.
$5 bill, still technically $5, but it buys less instant noodles, less gas, and doesn't actually have as much value as it did before. So what actually causes it? Sometimes people just have too much money. Everyone's got cash, and they all want to spend it on the same stuff. Let's say 2,000 people want this $500 TV, but the business only has 1,000 TVs for sale. So the business goes, oh, everyone wants this TV? That'll be $800 now. Sometimes it's supply chains with hiccups or problems, making the cost of producing a good or service more expensive, meaning the cost of that good or service must rise. Or sometimes, just cause. Expectations can cause inflation. If people think prices are rising, they'll spend more now, driving prices up faster. It's a self-fulfilling economic prophecy. A little inflation is normal, even good.
Oh, what's going on?
That's fine.
Yo, my guys here, Green Energy Gem, I appreciate you. What's going on? Embellished, LOL. Sir. All right, let's go.
Predictable. But if it spikes, savings die, wages lag. The government tries to fight inflation when this occurs, by raising interest rates. When the government raises interest rates, people are paying more interest, or it's more expensive to get a loan, meaning they have less money to spend on things like TVs. This causes a reduction in the amount of spending, pretty much cooling off the economy. Recessions. A recession is when the economy decreases for at least 2 quarters, or 6 months in simple terms. One day you're fine, you've got a job, bills are paid, you might even be planning a trip with the family, but suddenly there's layoffs, the stock market's only going down. In a recession, jobs vanish, companies cut costs, and everyone saves their money for necessities instead of buying things they don't need.
Yeah, recessions, Hey, this is why it's good to always have more than one things going on, because recessions are bad. Um, but yeah, with that said, I think I'm gonna end it here because my alarm is saying it's time to go. Yes, guys, I put an alarm for myself because brother man loves to talk to you, and I can't keep talking. I got, I gotta go. I gotta go. I gotta go. Like, subscribe, Levi Apparel. I appreciate you. I appreciate you.